Welcome back to the deep dive. Today we're tackling a really interesting, maybe even slightly uncomfortable question. When CEOs greenlight these massive share buybacks, is it brilliant market timing or are they just, great operators who sometimes get a bit lucky?
That's really the core tension, isn't it? I mean, the theory sounds perfect. The CEO, they know the company inside out, future cash flows, all the internal stuff no analyst sees. So they should be the best timers, right?
Yeah, theoretically. But before we dive into whether that holds up, let's just quickly remind ourselves, and you, the listener, what exactly is a share buyback? The pizza analogy is still the best, I think.
Oh, absolutely. It's simple. Imagine the company is a pizza. Let's say it has 8 slices or 8 shares. If the company uses its cash to buy back 2 of those slices, well, now there are only 6 left. The pizza itself, the company's total value, hasn't changed size, but your share is now a bigger piece of the whole pie. It's worth more.
Makes sense. So logically, CEOs should be buying back those slices when they think they're, undervalued or cheap. But the sources we looked at suggest something different. It's more about operational skill than market wizardry.
That seems to be the pattern, yeah. Most CEOs, they climb the ladder because they're fantastic at running the business itself. Managing supply chains, developing products, making sales happen. They're like expert business chefs. They cook a great meal.
But being a great chef doesn't mean you know when the restaurant's stock is a bargain on the market.
Exactly. They might not be the best gamblers, so to speak. Running the factory floor is different from watching stock tickers all day. It sort of confirms that, well, not every CEO is secretly Warren Buffett.
Okay, I get that. But shouldn't someone running a massive company, a multi-billion-dollar operation, kind of have to understand valuation? Isn't that part of the job?
You'd think so, wouldn't you? But the data, and maybe just the reality of their focus, suggests they're hired primarily to run the core business well. The market timing aspect might be secondary.
All right, let's dig into the numbers then. How does this play out in the real world? There's some pretty stark differences just based on where the company is located.
Yeah, huge variation.
Yep.
So in the U.S., a company announces a buyback. Boom. You typically see a short-term stock price jump, maybe around 3.5%, pretty quickly.
Okay.
But you take the same announcement over in Europe, the reaction is much more muted, closer to, say, 1.5%. So investor psychology or maybe market structure definitely differs region by region.
And what about the long game? The idea was that buybacks created this sustained outperformance, this premium, that extra return you get, compared to just holding the general market. Has that held up?
That's where things have really changed.
Yeah.
Back in the 1990s,
Yeah.
companies doing buybacks saw like a 7 to 9% extra return over 3 years. That's significant, a real premium.
Wow. Okay.
But fast forward to the 2010s, markets got smarter, maybe more efficient, transparency increased. And that long-term extra performance, it pretty much vanished, dropped close to zero. The timing edge just wasn't there anymore, generally speaking.
Close to zero. So the magic's gone. Except, wait, there's this massive exception we found, right? It gets really interesting when you look at value stocks.
Exactly. This is the big asterisk. Value stocks, companies the market generally sees as cheap, maybe overlooked, but potentially promising. Research found that when these types of companies announced buybacks, they massively outperformed. We're talking something like 45% better than non-value firms over 4 years.
45%. Okay, that's not just noise. That's huge. It suggests that when a company the market already thinks is cheap also signals confidence by buying back shares. Investors really listen.
It's a powerful signal in that context, absolutely.
Yep.
And size matters too. Small cap companies, they tend to get a proportionally bigger kick from buybacks. Large multinational giants, often the market reaction is minimal, sometimes even negligible in the long run. And in some places like Greece or Spain, studies even found negative long-term returns after buybacks in certain periods.
Huh. So if the market timing benefit is weak or non-existent for many big companies, why are they still doing so many buybacks? It must be driven by other things, right? Internal factors.
Precisely. It's not always about timing the market low.
Yeah.
There are key corporate mechanics at play. A big one is boosting earnings per share, or EPS. That's just net profit divided by the number of shares. Fewer shares means the EPS number automatically goes up, even if profits stay flat.
Which looks good on reports and often links back to how executives get paid, doesn't it?
It very often does, yes.
Yeah.
Executive bonuses are frequently tied to hitting specific EPS targets. So there's a built-in incentive there that might have nothing to do with whether the stock is actually cheap. Other reasons, things like tax optimization, could be more tax efficient than dividends in some places, or even defending against a potential hostile takeover by consolidating ownership.
Okay, so let's try to synthesize this. CEOs. Mostly great operators, maybe occasionally lucky market timers. The immediate stock bump. Depends where you are. The long-term boost. Mostly gone, unless you're looking at these specific value stocks or maybe smaller companies.
That's a good summary. The key takeaway for you listening is that the broad, guaranteed benefit isn't really there anymore. But it can still be incredibly powerful in specific situations, like for a company perceived as cheap, that signals strong self-belief.
Which leaves us with a kind of provocative final thought, doesn't it? If these buybacks are often driven more by hitting bonus targets or optimizing taxes than by seizing genuine market opportunities, are shareholders potentially missing out? Could that cash be better used, investing back into the business itself, maybe for growth? It really brings up questions about the best use of capital.
It does. But at the end of the day, if the stock price goes up, shareholders tend not to complain too much about the why, whether it was skill, luck, tax planning, or just solid operational results. Sometimes good performance is good performance.